Good morning and welcome to the fifth in this series of IMAP's virtual InvestTech. It's been a pleasure for us to host these through the course of this week and to have a chance to spotlight some of the key ways in which technology is impacting the provision of managed accounts and the way in which managed accounts and advice more generally is being shaped by the decisions which licensees and advisors make in respect of technology. Firstly, a few words of thanks to our sponsors for this whole week. This wouldn't have been possible without the contribution which each of them has made, both in terms of participation and in providing the support to IMAP that enables us to draw together both sponsors and, as we'll see today, a number of what to my mind are really interesting participants in this market. Before we move on, a couple of things which I'm sure will be familiar to many of you. If you have questions, use the Q&A button at the bottom of your screen. You can also use the chat function, and that'll be seen by the panelists and the rest of us. Your question may not be answered immediately through the course of that presentation, but I know that each of the presenters will come back to you personally. You have a choice of anonymous contributor or your name. If you do want an answer to your question, put your name in. It makes it possible for us to respond either there and then or separately by email. So today we are going to be talking about two advice success stories. IMAP each year runs the IMAP Managed Account Awards, and we invite participants to enter in both the asset class categories, the licensee category, or the innovation category. And both of today's presenters, Wealth02, Shannon Bernasconi from Wealth02, and Damian, Cilmi and Adam Pointon from Praemium, were entrants in the innovation category. Last year, in fact, Praemium were the winners of the innovation category. I thought it would be very interesting today to highlight Wealth02's portfolio rebalance capability, and then secondly, Praemium's ESG capability. These two areas seem to me to be particular areas of focus for advisors and to speak to particular challenges which advisors face. So it's now my pleasure to invite Shannon Bernasconi from Wealth02 to talk about their portfolio rebalance capability and the role that it plays in a managed account advice service. Shannon, thanks very much.
Great, thanks Toby. I'm going to just share my screen in a sec. Just do that. Great, excellent. Thank you again, Toby, for the opportunity, and thanks IMAP for hosting this week of very informative webinars. As mentioned by Toby, we were a participant entry in the Innovation Award, and hence Toby asked if we could share in that technology innovation today. Managed accounts, particularly those under discretion, are sometimes put under the scrutiny of being too cookie cutter and not tailored to the client's best interests nor the market conditions. What I hope to show you today is how advisors can customize managed account portfolios for their clients while still gaining the economies of scale and efficiency of managed accounts. And there are three main areas of tailoring that I'd like to focus on today, namely the upfront construction of the portfolio for the client and the tailoring that can be done there. Secondly, the rebalancing of that client's portfolio into the market. And then thirdly, what can be done on the actual execution of those transactions into the marketplace. We only have 20 minutes today, so I won't be able to show you everything of what Wealth02's rebalancing and managed accounts functionality, but I will focus on these key aspects to provide that information of how you can tailor clients' managed accounts and still gain scale and efficiency. So first, let's have a look at the portfolio construction and how to apply best interests for a managed account portfolio for a client. So there's a couple of things that can be considered when constructing a portfolio or managed account for a client. First is the minimum trade parcel. So this is a dollar value that's set under which orders are not placed, so $1,000 for example, and it's there to minimize the erosion of performance by brokerage, and also to minimize the costs of self-managed super fund accountants where there's a lot of parcel and noise. So setting that is obviously important, but at the same time, when you do set a minimum trade parcel, if you aren't able to meet that in terms of the rebalance, with the low interest rate environment, it's also good to consider whether all of those small parcels are added up into a single investment into the market to keep your clients fully invested. And in our language, we call that a default security. So it's like a parking lot for those small parcels. The next area of customization is around the franking and CGT implications of 45 or 365-day rule to stop the rebalancing from actually selling those parcels. So that is something that can be considered on a client level as well. Now, in terms of the application of SMAs and managed accounts, often that cookie cutter discussion is related to the fact that it's often 100% allocation to a specific model, and there is no tailoring around the model itself. So in the case of the construction of a client's portfolio, one can actually blend models and or other percentage allocations to other securities as fits that specific client's needs or advice. But saying that, when you do use a managed account model, sometimes there are ethical reasons that your clients are not wanting you to buy into a specific security, or they might have directorships that prevent them from doing so. So having the ability to override that at a client level is also important. Similarly, the ability not to sell when you are holding a specific parcel, maybe it's from tax reasons or an emotional bias to a specific asset. And lastly, around the tolerance levels that you set to which then the rebalance is triggered. So what materiality do you want to have to trigger a rebalance for your client? So having a look at those and applying them in terms of the actual technology, starting with the minimum trade parcel. So as I mentioned, setting that, and that can be a set at a client-specific or template level, the 45-day rule, as mentioned, as well as the 365. The security and asset class tolerance levels, so that you can control the sensitivity by which you trigger a rebalance of that client's portfolio. The minimum trade parcel set, as I mentioned, you can have default security, so you can invest, in this case it's AAA, that you would invest those small parcels into. Add a portfolio construction of what assets are invested in. Here's an example of 90% allocation to a model, and then the client in this instance needed some liquidity for a personal event, so there's an additional allocation to an at call and an exposure to an international. The do not buys and do not sells, here we've got an example of each, and in this case it's pro rata by asset class, but you can do substitutions. And if we look at the effect of that on the actual portfolio, where we said we don't want to buy something, it's then pro rata increased for the remaining assets in that asset class. Where we don't want to sell something, it is reducing down the others in the asset class to keep the asset allocation consistent to what you wanted for that particular client. So those are examples of how you can use the technology to implement that client-specific portfolio, and you can see the color schemes there to indicate the materiality of how overweight or underweight the clients are at a security level there. So that's a summary of how to tailor a specific client's needs at various levels within the actual portfolio. And then obviously once you've done that, you can then take it into the effect of the bulk rebalancing. So if we have a quick look at that, we could go and rebalance every client individually, but much more effective is to do bulk rebalancing across all those tailored client portfolios. We at Wealth@2 offer both discretion and non-discretion accounts through the managed accounts. And this example in the screen is showing you how to bulk rebalance, firstly discretionary, and which we'd go straight into trading. You can also bulk rebalance those clients that have not given discretion and want to get an electronic record of advice, and which is electronically sent to them, and on their permission, authorization, we execute through intraday into the market. So the purpose is to show how you can tailor your clients at a client level, but still get the economies of scale and efficiency through the bulk rebalancing after you've done that tailoring of those client-specific needs. The next level of tailoring is actually is something new that we've launched recently, is within the actual rebalancing itself. So you've tailored your clients, but now we're actually going to do some further tailoring actually when it comes to the implementation of that rebalance itself. Now, why would you look to do that? Well, it could be that there's a specific market condition that makes you want to not trade a specific asset class or a specific asset, or you may see an opportunity in the marketplace you want to get your clients into, or it could be that you've got multiple models and you only want to implement one of the models today. So there's various reasons why you would want to do these tweaks, and it's typically at a high net worth level that this kind of functionality is utilized. So if we have a quick look at the new tool, firstly, you can rebalance it at asset class or at model level. You can just get into a market opportunity, like an order pad, and choose whether it be a dollar percentage of portfolio or units that you want to get into that specific asset. Resetting the rebalance shows you what is calculated. You can say, I don't want to go into Australian shares today, or you could say, I want to override a specific hold, which is a minimum trade parcel in this example. You can also choose to isolate at an individual's asset level of the asset class. And as I am amending these trades, you're able to see the changes in the proposed asset allocation. So as I change there, it's changing the proposed at both the security and the Australian shares level, so that you all the time knowing what the implications of your tweaks and changes are for this client, as well as the cash that is resultant of these transactions. We've also got a tool where you can export all those transactions as well as import. And so if you do use your own methodology with regards to any trades, you can apply that. Here's just a warning on the minimum trade parcel, which can be bypassed if you're happy to do so. And it shows you then the summary of what we're going to execute through into the market. You can provide limit order instructions or put some file notes for this rebalance as required for audit. For those that don't have discretion, you can generate an ROA, or if you've already got permission, you can bypass it and proceed through into the market. Going back, it remembers what I've previously said we should do, and it's just showing you here how you could say, actually, I want to do something different on BHP, so I go back in, make my amendments, and it's dynamically calculated what the effect is on my proposed asset allocation as a result. It's also given me a warning of minimum trade parcel, which is fine, and it proceeds through and does the checks and then proceeds through to the checkout for me to progress through into the marketplace. So in a summary of, in terms of the new rebalance, it provides further flexibility for the market and all clients' purposes specific, much higher levels of customization in the actual rebalancing process, and the ability to execute specific asset classes and or specific models or security level. It allows for that dynamic calculation, so you're seeing what the effect of your trades are real time, and you're able to do your tweaks accordingly, as well as manage the impact of liquidity and cash. The tailoring can be used under both discretion, as well as those that want electronic record of advice sent to their clients for electronic authority. And we can also, what we're seeing is some of the higher net worth advisor groups are using this to be able to produce a document for a one-on-one service review with their clients, and then being able to reload the trades that they've previously exported and directly execute those into market after their review meetings with those high net worth clients. So it's very powerful tool for those that are looking for that next level of tailoring within the actual rebalancing itself. The final part of the tailoring focus that I'm bringing today is that of implementing best interest duties during the actual execution of those trades to market. And that could be whether it's limit orders, managing liquidity of the market makers, intraday execution throughout the day of the ASX being open, and knowing the timing of the market for certain assets, bulk processing of those trades at a single price and rebooking to all the clients equally, as well as the management of liquidity. All of these make an effect in terms of the contribution of a better outcome for the client. And that's the discussion. Toby.
Thank you very much, Shannon. As I mentioned, if you have questions for any of the presenters, use the Q&A button down the bottom of your screen. And Shannon, a couple have come in. So the first one concerns the technology itself and asks, does the rebalance work just for funds, managed funds or wholesale funds, or is also a direct securities tool?
Yes, so thanks, Rakesh, for that question. It is for both listed managed funds, as well as ETFs, as well as term deposits and at-call accounts all in one. And then we also manage unlisted assets for the high net worth clients, which is all part of that same rebalancing. So all the assets included in that.
Right. And sort of a supplementary to that, I take it that, as I think we saw, all the portfolios that are associated to a model and their degree of compliance with the model are visible in a single screen.
Yes, so obviously I didn't go through all the strategic asset allocation or tactical calculations in this demonstration, but that is all part of the portfolio construction and monitoring that we offer.
And I take it that the technology which you've developed is an intrinsic part of the Wealth02 platform rather than a standalone tool.
Correct. So we are a service for advisors, and we're an alternative platform solution for advisors. So whilst we're not a product and don't have a PDS, we're akin to the other peers in the platform space in terms of that holistic end-to-end service offering for advisors.
Yes, we all wish that ASIC would recognise that MDAs are services and SMAs are products and craft their approach accordingly.
And we do have a superannuation on HIN for the same, so it's like everything else. It's but that technology that I've just shown applies to all types of clients, whether they're investment or superannuation clients.
I'd like to touch on the best interest issue because it seems to me that so much use of managed accounts over the next couple of years is going to be dependent on best interest. I mean, to what extent do you see these types of tools enabling advisors to sort of hand on heart say, yep, I recommended this because this was the way I could meet your goals?
Well, obviously, going from cookie cutter to this much tailoring, it's quite evident that you've had some thought process through the process that could be audited by anyone and seen quite clearly that you've done something specific that is specific for that client, so it always relates. But I think also the clients are actually asking for this level of value from their advisors. And obviously, the more high net worth, the more specific tailoring that goes through. But even just the little things like knowing that if a client, even if they're small, needs a liquidity event, the ability to actually have some excess cash and investments in some liquidity is important. So whether they're small and they just need that, or whether they're bigger and they need a lot more tweaks in terms of their best interest. I think the important thing is when ASIC walks in the room and they're getting more and more focused on this in the new year, how you can say that everyone was the same if you've not considered any of these aspects, I think is something that advisors should be more cognizant of. You know, they all want to do the best interest, but you also want to have scale in your business. So that's where we believe that the two can come together using the technology in this manner that I've shown today.
And is this technology for use in an advisor office by an advisor or in a sort of centralised administration setting, or both?
It's both. We really see Wealth2 as a service to, like an extension of the advisor's own practice. So we work very closely with both the advisors using the tools as well as their support staff equally. So there's lots more behind what I've shown you today. I just really wanted to focus on the topic, but ultimately it's about every part of the value chain of implementation of advice, right through to the reporting and the ongoing service and communication to the clients.
Right. And look, a final question from Nick Netterchin. Does the platform handle US listed securities as well?
Yes, via Traces, which is through the Chi-X. You can trade through the broker accounts on the US market currently, and then we will be looking to offer all markets in the new year. Great.
Well, look, Shannon, thank you very much for your time today. We'll be posting a video of today's sessions through the IMAP website, and you'll be able to go back and review that. We'll also be making available a copy of the slides for those of you who are interested or want to share them with your colleagues. So, Shannon, thank you very much for your time today. It's now my pleasure to introduce Adam Pointon and Damian Cilmi from Praemium. ESG is an absolutely central part of the emerging advice environment. We've been through bushfires. Climate change is a continuing challenge for us, and more recently, we're seeing some of the implications of coronavirus or COVID. Increasingly, part of the role of the advisor will be to ensure that a client's portfolio reflects their personal beliefs, but those beliefs are very varied. This client says, oh, I just don't like liquor, or I don't like armaments, or oh, I don't like offensive armaments, high impact armaments. This client says, I don't like gambling. We're incorporating these issues into a portfolio is really extremely difficult in a pooled context. And yet at the same time, we're seeing many fund managers bring out ESG or responsible investing portfolios constructed in accordance with their framework. Part of the advice challenge is to understand the way in which an individual client's goals can be captured in a particular product or a particular investment approach. So we were delighted in the Innovation Award entries this year to see a number of people addressing ESG. Nucleus, I think of in particular, but also Praemium, who in a mainstream platform introduced the capacity to customize portfolios in a way which does reflect each individual client's goals. So it's now my pleasure to hand over to Damian Cilmi and Adam Pointon from Praemium to talk through their ESG screening tools and the way in which those enhance an advice offer. Damian and Adam, over to you.
Thank you. Thanks, Toby. That was a wonderful summation. I almost have nothing to add to that, so thank you. But we have a presentation here. Hopefully, Adam can bring it up on screen to really showcase our submission to the IMAP Innovation Awards this year. So as Toby mentioned, we did win the award last year. There was a lot of pressure to go back to back on it. We thought we had a great idea. I think we just got pipped on some very great entries this year. But this one here, I think it really feeds to our, I suppose, culture of innovation and working with clients to try and understand the issues of how to create scale, but also some customization in there and deeper investor engagement. And as Toby touched on with all of this, is that ESG and values from individuals, it's hard to scale that because everyone is so different. So this is why it was so challenging to do this piece of work. And we think hopefully we've come up with something that makes everyone's life easier to deal in that individual nature of people's values, but try and do it in a scalable way. So we'll go through just a bit of a background, quick one on ESG. I think you all know it, but then we'll just really showcase the technology for you. So, so what we've got there is just some high-level information around the investor demand is surging, and Toby touched on bushfires. I think anyone who is on this call knows that the amount of interest that came about on the back half of last year to the start of this year around environmental aspects in people's portfolios, it was huge, and it's still continuing through right now. And Morgan Stanley, they've Institute of Sustainable Investing, they produce a lot of great reports in this area here. And through their surveys of investors, they show that 84% of respondents want the ability to tailor portfolios to certain impact, their own impact objectives. And at least 52% are already engaged at least in one sustainable activity. So it's big numbers in there. Now, the other thing now when we talk about investors and advisors, there's a lot more product supply that's come on that advisors need to evaluate and whether it will meet the needs of our clients. The other aspect that we've got is information supply is increasing, and that is investors are getting more attuned and more aware of the activities of what companies are up to. And so classic one is, you know, Woolies in their involvement in pubs and pokies, and people are more aware of that kind of thing and saying, well, do I really want to be owning a gambling stock? And that's what Woolies does have, you know, a fair whack of earnings from that one there. And here we'll continue to talk about this, which is the broad range of ethical considerations from investors. And what we've found, see, Shannon talked about this one before about, you know, her platform that has, you know, the do not buy override. And we do as well. We've had it for many years. And that was kind of where we started looking at this one here, is how people were using the do not buy override technology. And what we found is that there was a lot of use of it for ESG considerations. But then the interesting thing that we found out of it is that they weren't equally replicated in the same way that a typical ESG fund that's out there that would do the big four of alcohol, tobacco, gaming, and weapons or adult entertainment. Not everyone selected those four things equally. So, you know, a good example of it is that a lot of funds, a lot of investors want climate change or fossil fuel to be dealt with in portfolios, but there's a small amount of funds out there dealing in it. The reverse is also true, where tobacco is excluded a lot, but it's probably not as high on investors' minds. The next slide, please, Adam. Okay, so this is, I suppose, the traditional options that you have at your disposal. And that is, you know, to buy pooled vehicles and hope they meet investors' demands, not only now, but in the future. And that's kind of also another trick out of all of this. You might be able to analyze the holdings today and say, okay, that kind of meets what my client's looking for, but do you have the confidence that it will always meet the client needs in the future? And that's a very taxing and intensive piece of work for advisors to do and keep on top of. The other option is, if you don't have confidence in the pool vehicle exposure, you could build what we would call an IMA portfolio, individual account for your client of 20, 30 stocks, exclude certain things that they don't want in it. You would have to deliver that over Aussie equities and global equities. Not all advisors have necessarily the desire or expertise to execute on that one there. Or the third one is to use an SMA and then go in and manually exclude or substitute stocks. Okay, so you go in one by one and you knock out your Woolies, you knock out your Whitehaven Coal, so on and so forth. But again, a very manual exercise. And we think we've got a better way to deal in that solution there. So I'll hand over to Adam and he'll talk through, I suppose, some of the background from a tech point of view and how we innovated on this one here.
Thanks, Damian. Yeah, so we looked at, I guess, all those problems. We looked at the need to look deeply and do all that research, either at an advisor level or at an investor level, and keep up to date with that as it changed constantly. And then on an account by account basis or an investor by investor basis, applying that is okay. But again, you need to constantly update that on the research, have it a very individual bespoke experience, which we can do today. And as Damian mentioned, we had clients that were doing that through what we call a holding lock or locking a holding so it does not get sold or ignoring something. It was very expensive, high effort. It really went against the grain of managed accounts and the many benefits that managed accounts bring, but in particular, just having a very bespoke, customized experience, but at scale. So our theory was, what if we could actually source that research in a very alive, ongoing way, and then apply it at scale across all of the managed accounts, which would then result in an individual experience down to the investor or the investor's account level if they wanted to go further down and have an ESG on their super, but not on their other investments. And how would we be able to bring that to the managed account at scale? And that's essentially what we will show, and that's where we came from and how we delivered it. So Damian, if you want to talk through this one, which sort of compares the traditional approach to the Praemium approach and how we're applying it.
Yeah, thanks, Adam. Yeah, so this is an example, a real life situation that many advisors face and how they would deal with it. And we've kind of broken it up. We'll run it in parallel just so you can see kind of where this technology is going to go. So starting with the grey bars, the grey boxes at the top. So traditional situation. Client comes in and they invest $500,000 into an Australian equity SMA. And this client does not want to invest in companies that support or participate in thermal coal or gambling. And after the investment's made, the client has a look at, the advisor has a look at the holdings and sees that there's BHP in there, and the advisor works out that BHP participates or has involvement in thermal coal. So what the advisor would do in that instance there is put a lock, a do not buy on BHP. That would remove it from the portfolio. Problem solved, at least on that one there. They've had a look at gaming and they say, okay, there's no gaming stocks. We're all cool there. I'm satisfying my client's needs. But then something happens because the manager is changing the portfolio, buying new stocks every day, and there's a change to the lineup. And I've just used a fictitious example of Metcash now comes into the portfolio, and the advisor works out, okay, Metcash is in there. They actually own a whole lot of pubs that have got gaming machines. I should now go and remove that from the portfolio. So the advisor in that case has to look to see what holdings have been brought into the portfolio and react, and also be on top of the research, the granularity of all of the issues with the individual companies. So under our scenario here, we've just taken the exact same scenario. The client buys the same Aussie equity SMA. The client has the same requirements: no thermal coal, no gaming. Okay, they select those filters at the start, at the initial. That can be done at any time, but let's say it's done at initiation of investing into this portfolio. Yes, under the same scenario, BHP was held at day one. That would be excluded from the portfolio. That weight there is 5% and will get reallocated throughout the portfolio. Then the manager brings in Metcash into the portfolio. But with our system, it knows that it's not allowed to buy gaming stocks. Even though the SMA manager has brought it into the portfolio, this override, this ESG override for no gambling means that Metcash won't get purchased. And again, the weight for Metcash will get reallocated across the rest of the portfolio. So that's it. That's in the dynamic sense how it all works. So Adam will show you some of the tech now, so how the all the screens look.
Thanks, Damian. So this is our advisor portal. I've just sort of logged in as a demo advisor here. And I'll just pick on an individual investor. So here's Bill. Bill has a number of accounts. And in this example here, he has an SMA. It's a company account, about $40,000. It's invested in a number of models. So 37% in a balanced model and some individual stocks and some funds in there. And you see this bottom section here, customizations, and that's where this example is on a client level. We can do it on an account level. We can do it at a client level, where the advisor will come in and say, okay, Bill wants to hold these and sell stocks for some particular reason. He's also substituting out ANZ for a tech ETF for whatever reason, or Rio for something else. He's got an exclusion on Santos for some particular reason. It could be he's a director of Santos and therefore can't trade it without clearance at a corporate level. This section here is the ESG. So you can see Bill has no alcohol production and no gambling. And simply go in here, click on the ad, click on the drop down as Damian mentioned. So I'll just add oil and gas, go into the next section, and the current customizations are on the left and the new customizations are on the right. You can see down here, it's probably a little bit hard to read actually. I'll just zoom in. This account currently holds BHP, Woodside and AGL. So it's telling us that 7.28% of this account will be sold down as a result of that ESG customization. And so they simply click submit, and on the next rebalance, or that will effectively go to market at the next time that it is traded, which will typically be daily. And that ESG exclusion then persists for the lifetime of that account until they go back and choose to remove it if they want to. So that example of oil and gas, if there's a new stock that's chosen by, in this example, the Morningstar Balance model, if a new stock comes into that model that meets those ESG categories that are excluded, then it will simply be not traded, as Damian just described earlier. Pretty much the end of the demo, quite simple, quite straightforward, as you can see.
Thanks, Adam. No, that's good. Great. So now we'll just talk about the ongoing management and support around this one here. We haven't talked about it, but so our research partner is Sustainalytics. They cover 15,000 stocks, both domestically and globally. So it works across all equity-based SMAs on our platform. So what we do, we get monthly files from them to update the research as new information comes out on individual stocks. They have a team of nearly 700 analysts working through all these companies. So activity to do with companies can change regularly or in the filter. So a company, you know, we use the probably surreal example of CSL may elect to go and buy a winery in the Barossa. So then that would come out of the alcohol stock once they've bought that winery out there. And that's the kind of activity that this system will capture. So you know that you've got a true to label and always up to date filtering service across your portfolio for your clients. And that saves advisors having to do it and being across what's going on with companies day in, day out. And 15,000 companies is a lot to cover. What we do communicate to users of it to tell them that a change would be occurring on there. So we do give a notice period on there. So because there could be some issues that they still want to keep the stock for whatever reasons it may be. So they can take preventative action on it to stop the sell down occurring within at the end of the month. So that just gives you an example of the engagement. And then more than anything as well, that you can also work with your clients to say, this is live, it's still going, it's adaptive. And these are the things that are going on with your portfolio that we are attending to your ESG and value needs for your portfolio. So there's some good information provided in there as to what's going on with certain companies. Last slide. Yep. So just in summary here, we all acknowledge that all clients are different. They want different things. Some will have a big focus on environmental issues, but don't care about tobacco and gaming. So many of the pooled vehicle ones, we have to buy it off the shelf and try and get your clients to fit. Doesn't really work in our experience. One of the other things that we've seen advisors come to us about is the FASEA Code of Ethics, and they believe that Standard 6 requires them to discuss and acknowledge ESG considerations with clients. So we're seeing more and more uptake on this, and then advisors scratching their head saying, I'm going to ask this question, but I don't know how to solve for it in a scalable way. So we really think that this helps out advisors immeasurably in this. And we think that managed accounts are the best vehicle to deliver this. It's a scalable solution, and you've got individual tailoring. And that's kind of the paradox that we're trying to solve for here. And lastly, the engagement levels, it increases between the advisor and the portfolio and the client. And managed accounts are the conduit. And I think all advisors are always looking for positive stories and positive engagement to have with their clients. And we think this is a great way to have that conversation and increase the connectivity with investors. So that's all from us.
Great. Damian and Adam, thank you very much. Thank you very much for that. Very timely. And a couple of questions have come through. So one of the first questions is, does this screening cover both managed funds and equities and domestic and international? So,
yep. So good question. So not managed funds and not ETFs. It does cover domestic equities and domestic and international equities. And the problem is with the screening on it, on managed funds and ETFs, it's, even if we found out what was going on about it, you would have to sell the whole holding in it. And that's probably not the intention. The intention is really to deal with the individual issue, not to sell down a whole managed fund because it may have a tobacco stock. So no, it doesn't deal in that.
So no look through for no look through. And a question for Enda from Enda. So how do you manage the net impact of exclusions and inclusions in performance reporting, and explaining the difference compared to the model or the benchmark?
Yeah, so that's something that we're trying to work through. But effectively what happens is the client will have their own account reporting. So we've got performance by model. And the client can see at their individual basis what's occurred and the impact of it by comparing it to the unadulterated or master model that's had no changes on it. So one could put them up side by side and see what the impacts have been.
And apart from anything else, I mean, individual client performance is as much affected by cash flows as it is by these sorts of changes.
Yep.
So then what about the access for advisors to what's actually going on? You had a little example there of a notice to clients about whatever it was, Coronado
Yep.
So what access do advisors have to know what's going on in the portfolio, and do clients have to know what's going on in the portfolio?
Yeah, so we've taken the view, I mean, and there's a lot in this. As I said, there's 15,000 companies researched in it, and any given month, you know, we could see probably 100 changes of companies moving in or out of filters. Yes, there's a vast, not a vast majority, there is a lot of companies that are not within our universe. So we offer stocks across MSCI World Developed Market countries. So companies maybe in Malaysia or, you know, Taiwan, etc. We're not going to include within those notices because they're not relevant to our scheme. So we've taken the opportunity to create notices to advisors and clients where it's pertinent to their portfolio. So you've selected that filter and you've got that stock, we provide them with that notice. There will be some additions in the future where we look at more broader, I suppose, thematic pieces about changes that are going on as well. But at the moment, it's going to be specific notifications where you've selected the filter and you've got the stock in the portfolio.
Right. Now, Sustainalytics is obviously a subscription service that you subscribe to, so I'm assuming there's no cost to the advisor for having access to this. So one of my questions is whether the advisor then has access to a sort of a hypothetical of what would be affected if we, you know, had a no tobacco filter, for example. Can they drill through to see, you know, which companies, you know, from the universe would this knock out?
Yep. So two things on that one there. So Praemium's borne the cost of all of that. So we have an agreement with Sustainalytics on it. Costs a lot of money, and so we've borne that.
You got plenty.
Yep, thank you. We have not passed that on to investors, so it's free to use for anyone on that one there. And so Adam showed in the demonstration that they had the portfolio that was alive, and then they've selected, I think it was an oil and gas filter. And what it does, it tells you before it's affected that once you've selected oil and gas, there was 3 stocks, I think, under that example there, that would be sold down, and would sell down 7.9% of the portfolio. So at least you know what's going to happen prior to it occurring, because it is important where someone might want to go back and say, either A, it's a big number, I want maybe that much impact occurring on the portfolio, or actually like that stock, still want to keep 2 of them sold down, but not sell down the 3rd one. So
what about the, these are all, by the way, questions without notice for those of you in the audience thinking that Damian is extremely well coached in this. This is on the fly. So to what extent, for example, if a client says, right, no tobacco, can an advisor use the Sustainalytics analysis to have the discussion with the client, which is, okay, well, for example, that means we won't have any tobacco manufacturers, but it also means we won't have Woolworths or Coles because they sell tobacco, or we won't have Visi because they manufacture tobacco packaging, or, you know, this is where it stops. You won't end up with Metcash. And so to what extent can an advisor have a discussion about the impact, no pun intended, the implications of the client's sort of suggestions?
Yeah, so I think the first part is the ability to see what's going to be sold down from the portfolio prior to it occurring, and that could be a good starting spot for the client and advisor to have that conversation. See, look, we click on tobacco. Look, this is what could occur if we actually go through and implement it. So we've got a good talking point there for the advisor and the client on that one. And advisors are also finding out by just seeing the names on screen and the percentage of what will be sold down from the portfolio as a prompt to maybe go and investigate it and discuss it in more detail with a client. We've elected to go with a 0 materiality clause on this one here. in the first instance. We try to make it true to label, and in some cases, you've got other solutions out there who say, oh, we'll allow up to 10% earnings in it and so forth. We've gone very pure on it and say, you know, any dollar of earnings on it will knock out that stock if they do participate in that activity. We've got some ideas down the track where we do acknowledge that people may want to engage in some threshold management, if you will, and say, I'm prepared to.
Tobacco is an interesting one in respect to the retailers, because it's, you know, important but not material in their revenue. But, you know, it's, you know, if you have that zero materiality, I presume it knocks out Woolworths and Coles and
it does. Correct.
A lot of other retail, Caltex and a lot of other retailers.
Spot on.
Look, Damian and Adam, thank you very much for your presentation. You know, you were a worthy finalist in our Innovation Awards this year, and come back again next year with another idea.
Thank you. Thank you.
Thanks.
Thanks.
All right. Look, now what I would like to do is really wrap up the whole of the session. The first thing I'm going to do is launch a poll question. Your CPD is not dependent on answering the polls, but we value your engagement with them. Now, let me just briefly sum up what we've covered over the last 5 days. We've had a wide variety of presenters. We've had, the theme of the whole session was spoiled for choice, beset by risk. InvestTech is really about trying to encapsulate the central part that technology plays in the delivery of advice, and specifically in the creation and delivery of managed accounts. And every one of our sessions over the last 4 or 5 days, 5 days including today, was about that. And it really speaks to what it seems to me is a really important set of considerations for licensees and advisors. If you think that for an advice business, you are where you start today with an advisor best interest obligation, and you have a desired outcome, which is a unique service proposition, the advice service proposition. And along the way, you have to create a service design which says, okay, well, how are we going to get from meeting our regulatory obligations to having something which clients will value and pay for, and which will create sustainable, ongoing, enduring, profitable relationships. The thing which is become increasingly clear as advice has gone through a professionalisation process is that advisor best interest and other regulatory obligations have created, on the one hand, far greater complexity. This is not an advisor saying, I've got an APL with 6 balanced funds on it and one of them is right for you. So this has created a world of substantial complexity. And as both Adam and Damian and Shannon illustrated, an expectation by clients that the portfolio will actually be unique for them or individualized for them, or will be appropriate for their specific personal goals. So this drive for individualization and the creation of a complex environment can only really be attacked through the use of technology. Professionalization and training and a wider product variety, these are all contributors. But to move from my regulatory obligations as an advisor to my unique service offer, my differentiated advice service proposition, is really only made possible by the application of technology. And I've just illustrated a couple of points which through the last 5 days seem to me to be absolutely central to the way in which technology is brought to life. I've highlighted the use of institutional tools in retail, Milliman's yesterday with SmartShield was an absolutely excellent example of that. Franklin Templeton talking about Quantifeed and the way in which portfolio management tools have been embraced by advice businesses throughout Asia was an excellent example of that. Macquarie and Digital Portfolio Manager was an excellent example of that. A Refinitiv with the presentation with Nick Morton from Resonant talked about the way in which really nuanced data is surfaced for portfolio management decisions. Cost was highlighted by Peter Warren from Inzumo and by Tanya Searle from La Vista. This is not a cheap process. Peter, I think, in our very first session said technology will do more, but do not expect it to become substantially cheaper. And in the Spoiled for Choice in Managed Account session, where Zach Lehman from BT and Tom Schubert from Drummond and Brett Sanders from Philo Capital spoke about options available for managed accounts. One of the points that came out of that session was this isn't necessarily cheaper for clients. It isn't necessarily the cheapest solution for clients, but it certainly offers the best and most appropriate for them. And finally, working with specialists, we had Andrew O'Riordan talking about avoiding IT disasters. We had Pat Garrett and Tim Fuller talking about the development of digital portfolio tools, which could be incorporated into an otherwise standard advice process. So this seems to me to be a little conceptual map of the journey for advisors through technology from their best interest regulatory obligations to an advice service proposition, which really sets them apart. Portfolio management becomes part of it, but it's facilitated by technology. So I hope you've found the sessions that you've attended through the last 5 days worthwhile. We've certainly enjoyed bringing InvestTech to life for you. We found this a challenging format compared to the good old days of a single-day conference in Sydney. But I can tell you that well over 700 people have attended and participated in this, which is far more than would have had the opportunity to participate in a single-day event. So virtual conferences are here with us for the future. So now let me wrap up by saying that congratulations to the 5 lucky winners: William Tomac, John Zara, Daniel Park, Margaret Blunden and Chris Smith, who've all participated in the polling process. So thank you, Jenny, for organising that, and congratulations. We'll be sending a $100 voucher to each of these 5 people. So thank you very much for your time and participation, and we look forward to you joining us again at future IMAP events. Thanks very much.